Well, it is likely to be a status quo by the Reserve Bank of India, both in terms of the repo rate as well as the reverse repo rate, and RBI is likely to maintain an accommodative stance in the February policy. Well, the outcome is due tomorrow, 5th of February 2021, and the rationale for a status quo on rates and stance is the fact that while the headline CPI inflation has come off drastically in the recent month, it's largely led by cooling food inflation. Core CPI inflation still remains fairly sticky, and with the crude oil prices rising, there is a concern that higher crude oil prices may lead to still a firmer core CPI there. Besides that, of course, growth recovery, although is faster than expected, it is still fragile and the recovery is yet to take roots, and there is a need to still go ahead and support the recovery, both in terms of support coming in from the monetary policy and of course in terms of the fiscal policy. RBI's commentary in terms of how actively will RBI support the bond markets in order to keep a check on the rising long-term yields will be very, very important. The reason being that the 10-year yield has risen to a 5-month high, up over 15 bips in post the budget, and this is on account of higher than expected government borrowing of rupees 12 lakh crore by the government for the next fiscal, and also announcement of additional 80,000 crore of government borrowing over the next 2 months. This has led to pressure on the long-term yields, and hence the yields have risen, and there is nervousness in terms of on the part of the bond market investors. RBI's commentary on liquidity management would also be fairly important. A lot of economists are expecting RBI monetary policy normalization beginning sometime in 2021, but this would be firstly beginning with liquidity normalization in 2021, followed by possibly rate hikes in the next calendar year. RBI's commentary in terms of how much of liquidity surplus would they still be comfortable with in the economy would be important. How long will RBI continue the accommodative stance would be also keenly watched out for. CRR reversal of 100 bips is effective from end March 2021. This was a one-time measure by the Reserve Bank of India undertaken during March of last year on account of COVID. Will RBI go ahead and extend the same or not? That would be important. Some of the economists like Govt Securities expects that RBI may hike bank HTM limits to 4% of the book versus 2% earlier in order to fund higher fiscal deficit and contain yields. Watch out for that measure if at all. And also Govt Securities also states that they state that they think the MPC could express its willingness to maintain an accommodative stance at least into the first half of FY22, and hence watch out for the commentary in terms of how long will RBI maintain an accommodative stance. Overall, a status quo in terms of the rates as well as the stance, but commentary from Reserve Bank of India would be fairly important in order for the bond markets to take further direction on the rising long-term yield.